The reason you're not profitable as a trader is because you don't have a strategy that you believe in. And that is why you struggle with psychology, staying disciplined, following your rules, and just overall sticking to the plan. Because if you don't believe in the plan, why follow it in the first place? And by the end of this video, here's what I want you to know. You only need 5 steps to follow every single day to become a profitable trader. And here's what I want you to feel by the end of this video. That trading is easy and fun once you know what to do. I want you to apply these steps to the charts immediately and get started with your trading journey. All right. So here's what we are going to cover. Number 1 is volume. You don't want to trade when there is no volume in the market. Number 2 is support and resistance. Number 3 is risk management. This is important before you take your entry. And then we will finish with the exit strategies. All right. So let's go to the charts. Number 1 is volume. So volume, and most of you know volume as this indicator down here. Volume is very important because that is what creates these big moves. So how do you know there is volume in the market? Number 1 is if you just notice the pattern in volume, you'll see that there are spikes. And if you go even further, there are spikes at very specific times of the day. So this is when we have volume in the market. And this is when you want to trade. So volume is just a matter of coming to the screen at the right time. And with this strategy, we only trade 2 hours per session. Now, if you are trading the London session, then volume kicks in at 3 a.m. And I usually trade between 3 and 5 a.m. That is when we have the most volume. And in New York, volume kicks in at 9 a.m. to 11 a.m. Now it continues further, but these are the 2 hours that I am mostly interested in. So step 1 is come to the screen at the right time when there is volume. Number 2 is support and resistance. Now, with support and resistance, it's very easy. When you come to the screen at the right time, this is what price maybe will have done. Maybe it's an uptrend like that. And when you come to the screen, maybe price is in the process of creating a new high. So, what do? You draw the most recent low, like that. Now, if it's one low, then it's not really a level or a support or resistance. But if price comes to that low again and it is supported, and then bounces like that, then now you have support. And to the upside, now you have this new high. And if price comes to that high and it's resisted and bounces back, then you have a clear resistance. So let's look at a couple of examples. So if this is US30, let's go and analyze from 9:30. So if we come to the screen at 9, this is where 9 is. So you see that price has created this high. So notice the first time you come to the market, price creates this high. Then price comes to that high again and is rejected. So now this high up here is just an area of resistance. And if you look to the downside now, you'll notice that price had created this low, and then price comes to that low again. So in this whole area here, we have this area of support, price comes and it's supported there. We have this area of resistance, and even if you go to the left, you'll notice that this whole area is an area of support and resistance. And that is basically how you do it. We can also look at this example here. You notice that to the upside, we have these two, two touches. So this is an area of resistance. And if you look to the downside, we have one touch, two touches, price tries to go back there. Like we have several touches. So we have an area of support and resistance. Then the next step is risk management. Now let's talk about risk management before we talk about entries. So you've drawn your support and resistance and you are waiting for that breakout. So as you are waiting for your breakout, this is when you start calculating how much risk you are willing to put into that trade before it even occurs. And now you calculate your position. Like, are you using a 1 lot, 0.1 or 0.01? This is important. Now, once you have analyzed your risk and now you are ready to trade, the next step is entry. And entry is when price either breaks the low or the high. So if price breaks above the high, that is your entry, buy, go long. If it breaks to the downside like this low here, then you sell. Now, sometimes you'll get stopped out, but this is the strategy. So let's look at a couple of examples of the trades that have occurred. So this is a good example here. We have this high, this low, this is area of support and resistance. Then you see price at 930 breaks out. Then what does it do? Continue in the direction of the trend. Same thing here, but this is to the downside. We have this area of support. This is support. Notice how price breaks out. As it's breaking out, that is your entry. Stop loss is above breakout candle. You are targeting a minimum of 1:2. Same thing here. We have this area of support and resistance. And at 930, price breaks out. Stop loss below breakout candle. You are targeting a minimum of 1:2. Same thing here. Same thing here. We have an area here of support and resistance. And once price breaks out, you get in, stop loss above breakout candle. You are targeting a minimum of 1:2. Now, the last step of this whole journey is your exit. So, you want to know when to exit when the market is reversing. And we use a very simple concept. And we have an emergency exit. An emergency exit looks like this. So you have bullish candles going up and you have already bought. So at this point you are in profits. But then the next candle tries to go higher, but it's pushed down. So it creates a pin like that. And then it changes color to red. Now this is a red flag. It's not an exit, but it's a red flag. Because if the next candle breaks out like that and changes color to blue, then you are safe. You can continue holding. If the next candle is a bearish candle and is red, and you have already bought, exit this position. Let me show you a couple of examples. So if we go back again, you'll notice on this trade, price went higher, but then we got these two red candles. And they need to be breakout candles. So one candle, and then if the next one is a breakout candle, you exit. Because we want price to go like this, not like this. Let's look at more examples. Another example is this. So we took this trade going short, and then notice we got this one candle, this second candle. At this point, price is telling you it's about to reverse. So you cut your losses short. Notice we saved ourselves 50% of our risk. Let's look at another example. At this point, this one is a good one. So price goes higher and it does not hit our TP. In fact, it hits our TP at 1:2. But if it did not hit our TP, our emergency exit is these two red candles here. Let's look at more examples. This one was direct to TP. This one was a good one. So we got in, price never really broke out until here where we have these two red candles. And so that is your emergency exit if price does not hit your take profit. And so to recap the 5 steps, number 1 is volume. Come to the screen at the right time. Number 2 is draw clear support and resistance levels. Then number 3 is know how much you are risking before you take your entry. Then take your entry and then be prepared to exit when the emergency signal forms. So hopefully these 5 steps will drive you in the right direction. And if you are a nurse working abroad and you would want to work one-on-one with me, join our free Forex masterclass. Link will be in the description. I will see you in the next video. Peace out.